Good morning, ladies and gentlemen. Well, the risk dial has taken a turn for the better, i.e., it's climbing and it's, in my view, giving a bit of a buy signal in equities over bonds. Let's examine what the various central banks did last week and what the implication for assets are. And I think this was a seminal week insofar as it tells you to sell and reallocate. Before we look at what the yield curve has done and what the implications for next week are, let's have a look at some fundamentals to put things into context. So, the five-year forward inflation expectation rate finished at 217, and basically that is the same range as we were in 2018 and the beginning part of 2018, 2017, if we go back further. So we are here where we were in 2017 and 2018. What does that tell me? That tells me that inflation expectations are not accelerating. If we have a look at the 10-year break-even inflation rate, it's 222. So a gnat's hair away from where the Fed wants it to be, which is around 2. If we go further back, we see that we are basically where we were throughout the period 2010 to, let's call it, even here in 2018. Inflation expectations are just not accelerating. We have to accept that, and we have to draw some conclusions from that. If we have a look then after that, what the yield curve has done over the course of the week, we will see that 30s were absolutely stable. Ignore this 20s, it's wrong. T-bonds, absolutely nowhere. And all that happened is that the yield curve steepened or rather flattened, by taking the 2-year, the 3-year, the 5-year higher, the 10-year almost nothing, and the ultras almost nothing as well. 2 basis points on the ultras, and what is it? 1 basis point on the 30s. So the stability at the longer end is what is important to me, and that tells me that the curve will continue to pivot around this ultra 10s and ultra 30s. This is the vulnerable part of the curve, from the 2s to the 10s, and everything else is stable. Why? Because the inflation expectations are stable. So that is the first part of the puzzle. Okay, so now let's look at what the individual parts of the yield curve did. 3 months, absolutely stable. So what they're saying is that the Fed is going to a terminal rate that is expected by the market. Whether it's going to be 5%, 5.10, 5.15, it doesn't really matter that much. 1 year going higher tells me that the part of the yield curve which is steepening, or rather flattening, i.e. more inverse, those expectations of Fed cuts in late 23 or even early 24 are being taken out and will continue to be taken out. So anything in 2024 is vulnerable to further backup. That in turn is making the 2-year stable to higher. I really wouldn't be surprised if over the next few days and weeks the 2-year went up towards 455, and I wouldn't be surprised if the 5-year ended up towards 382. But what is significant is that the 30-year is going absolutely nowhere. Can it back up to 377? Probably. But it's not going to go a million miles away from there. And if you have a look at the move index, i.e. the expected forward volatility of bonds, you can see that last week it actually ended the week lower. Was it a little bit higher on Friday after that horrendous ISM and that very weird number for non-farm payroll, which I don't think is significant, but the ISM I do think is significant. That to me says that if we get a move back up to 107, 108, it'll be another sell, and that it'll end up somewhere here in the 80s. All that tells me that the yield curve is going to pivot around the long end and that we have stability in the long end, and it's only a question of where the terminal rate is going to be, which is going to influence only the short end. So if we look at something like 2s10s, you can see that it's beginning to go towards new highs, and we could easily see that towards the 1% area. And if we look at the 5s30s, that could easily touch this pivotal 11 basis points again, and maybe go a little bit higher to 16. Everything is pointing the same way with the fundamentals, i.e. the inflation expectations are well anchored. The market thinks the Fed is going to be able to solve the inflation problem. It's only a question of how high the rates have to go to do it, and it's only a question of how long they have to stay there to achieve the objective. So I think in the States, everything is pointing in the same direction, i.e. stability at the longer end because of what I've just told you, the anchored inflation expectations, which are at the same level as they were throughout that period, 2010 to 2018, 2019, and then a flattening, i.e. more inverse yield curve, where the short end takes the strain of the, let's call it, re-acceleration of the economy. But really what it is an economy which is still firing on nearly all cylinders, where the employment situation is very tight, and where we are just not going to see big swings into a recessionary environment anytime soon. Could we see them later in the year? Absolutely, but I don't think that it's imminent after that ISM, and I think that that keeps the pressure on the bonds over the medium term, i.e. they won't rally very much. They might not back up very much, but there is no reason to expect rallies in 10s and 30s. There is every reason to expect backups in 2s and 5s. Pictorially, in the very short term, and these are 300-minute bars, what does this look like and what does this imply? I basically want you to look at the price against the moving averages. This is the 2s, TUH23. You can see that it's well below the moving average, so any rally up towards 102.27 is a sell. Now let's have a look what that looks like against FV, i.e. the 5s. You can see that we're on top of that moving average. So basically any rally up to these kind of levels, it's a sell for something like 108.17. And the further down the curve we go, the better that picture looks. We are above that level, so we are looking for spikes up towards 114.28 to sell them for probably not much more on the downside than 113.24. And the further down we go, the better the picture looks, and the further above the long-term moving average we are. I very much doubt that over the course of the next week, we see the US below 128.09. But can he get there? Yeah, there'll be selling bouts, and anything towards 131, I think, is going to be a sell for that kind of level. And the 30s, that's the one that's sort of looking the best, and it's the most above the moving average. But the fact that it's just even that one is turning tells you that these kind of levels will be seen around that high 140s. Everything points to the same thing: stability, relative stability in the longer end, less so in the shorter end. And that relative stability is also evident in Germany. This is the Schatz basically going nowhere. Every time it pokes its head above 106, it's a sell, and it goes back towards, whatever that level is, around 105.50, let's call it. Nothing going on here. The pre-announcement of another hike and then a pause has the same effect of anchoring these yields around these levels, because the market is speculating that that is going to be the last hike before we get the stability of the ECB looking at what this tightening, and this is a significant tightening, right, from minus 70 to 268. I mean, nobody's going to tell you that that wasn't significant. And the European economy is much more rigid and less able to, how shall I put it, less able to quickly readjust in terms of employment, in terms of shifting to between sectors. So it's going to probably take a longer period of time of these higher rates to get the adjustment, and therefore everything even there is stuck. I would very much doubt that we can go much higher than 245 in fives, and revisit these kind of levels around 236 in tens, and that's all she wrote. It's not going to be an interesting period to be trading bonds. You have to be very, very precise. I told you for a couple of weeks, I've been telling you that we were transitioning from a trending market, and this is a trending market, or was a trending market, into a highly technical market where we're going to be trading between levels. So I really don't see that that has changed. I don't see that that is going to change. The thing that tells me that it's not going to change very much, and that you're probably going to see smaller deviations in all these markets, is the differential between the two. I think it's now stuck, and this is twos against Schatz. I think it's now well and truly stuck between 150 and let's call it 190, and it's going to trade here for a prolonged period of time. And if we look at the tens, this to me is significant. I think you're not going to see it below 125, and you could well see it towards 145 again, with the proviso that any time it gets towards 152, it's a sell again. And that has implications for DXY, and that has implications for gold. Let's have a look at those implications, and I will tell you why I think they're significant, because I think real money is transitioning and deciding to reallocate between gold and commodities, bonds, and equities. Let's look at these charts together. This is DXY on a weekly basis. And this is actually a daily chart of the differential between the US and the German 10 years. This is basically October, November. This is October, November. This is where the trend started towards a less differential in yields, and this is where the DXY took a complete dump, and now it's coming back. Last week was a key reversal week on, whatever you call it, on the dollar, indicating that the pressure is coming off the dollar and that it might trade back up towards something like these levels. Let's call it 104.60, 104.80, something like that, i.e. the differentials are being taken out and the dollar is doing better. So what we are seeing, what we are witnessing, is a complete unwinding of the differential trade and therefore of the dollar trade, which probably, if you look at these levels, since I don't think that those differentials are going to go much above that 152 area, I would have thought anything in the high 104s to 105 is a reasonable expectation for where the DXY will trade over the course of the next couple of weeks. What do I think is probable stroke sensible for Euro USD? Here we are, 105.20, 104.81, let's call it 105 between friends. That's the kind of level that I think is probable and why not makes sense to trade towards and then be out. Don't forget that I'm not saying that the differentials are going to go into reverse. I'm just saying that they are more likely to go towards in a range between 125 and 150 in tens. And if that is the case, you get this pressure off the dollar. And this kind of retracement level seems to be a very sensible aim for Euro USD. And now we come to gold, which is really interesting, because if you are going to get a period of a bit of stronger dollar, and if you're going to get a period of stability stroke more inversion in the yield curve, the last thing you want to own is gold. And here we have 1959, touched it, boom. I think it's much more likely to head towards 1830 and my favorite 1764 level again at some stage. And let's try to reason this out. If you have relative stability in inflation expectations, gold is not really something that you want. Why? Because you get a positive coupon in bonds, don't you? If bonds are going to be stable, i.e. you're not afraid that you're going to lose principal by owning bonds, or you certainly don't think that you're going to lose much principal by owning bonds, you will start preferring bonds to gold because gold has no yield. So you see where I'm going with this. This seems to be the most vulnerable potentially asset out there. Why would you want to own gold if you don't think inflation, if you don't think you need it to keep pace with inflation anymore, and if you think that you get a real yield in bonds? I don't see the reason to own it. and most probably we will have a move in the next couple of weeks towards these levels at the very least, if not down to 1764, as I said. I think the story of gold is over. Gold basically last year closed a little bit higher than it started the year, and it did its job. It kept you out of bonds and it kept you out of equities and basically kept pace with inflation, i.e. it did its job. That's what gold does. It keeps your money intact in periods when there is a problem with other assets for whatever reason. Once it does its job, you abandon it. You don't care how low it goes because you don't want it anymore. It's not, what's it for? So you go from an over allocation in gold to an under allocation in gold on a portfolio of a long only real money portfolio. If that is the case, there's going to be a hell of a lot of selling on any move up in gold, because people are going to say, I don't need it anymore. I much prefer to have a real yield. I much prefer to be invested in growth stocks, whatever. What I'm saying to you is I think this is a fundamental move now, a reallocation away from gold and possibly commodities towards bonds and equities. This is a weekly chart of TLT over GLD, and yes, I know that it's distorted by the fact that TLT has dividends and this doesn't. Pictorially, I can't show you a better chart, though I wish I could. Let's try and enlarge this area. So I went back, I haven't gone back, but I know that I told you when this happened that it was significant. And this would have been Q3 of 2020. And this told you to get out of bonds and buy gold. Okay, so this would have been, let's have a look what this was. Let's call it here. The 08-07, so the beginning of whatever that is, August of 2020. And basically it told you to get out of bonds and prefer gold. Now let's see what you would have done had you switched then, but we'll see that in a moment. And now we are turning, I believe. I believe that very soon, in a matter of months, we will trade back up here. And then we will see where we trade next. But to me, this is significant. I think gold has done its job. It's kept you safe since Q3 of 2020, and now it's turning in the favor of bonds and in the favor of equities. DBC with gold, not a great look, right? Is it likely to trade this 2291 support level? I think it is. And basically it is going to be very, very close, within a couple of percent of where it opened the whole of 2022 or closed the 2021. This kind of level is going to be, to me, significant, and you can see how it happened here as well, that we had this consolidation. So this 2188 level to me is important, and I'm going to put a line there. I simply think that it's very, very likely to do this kind of ABC and readjust, which, it's telling you that inflationary pressures are really not all that strong. And if that is the case, why would you think that the long end of bonds is going to back up a lot? I think it's much more likely to be the yield curve which backs up rather than the long bonds. They might be under pressure for a couple of points at times, but that's not going to be the end of the world, and they're going to come back. So it's more of a sell calls in bond prices rather than anything else. And this kind of level, especially if we go and have a look at oil, would probably imply that the monthly is going to touch this 62 area, whether it's 62 or 65, who cares? Where it's probably a very decent buy. But regardless of whether it stops around here or it goes down or whatever, it's telling you that there is stability in the oil market. There's stability in even in copper. Let's have a look. Here you have copper on 285 minutes. Is it going up a little bit? Yes, but if you look on the daily, it's still the moving average, the 200-day moving average is still coming down. Has it got room on the weeklies to come down? Absolutely. And even if it doesn't, this is the interesting part, it's coming down against, it's not moving against gold very much. Everything is telling me that you're going to get a period of stability now in the bond market, and also in the metals, and also in the commodities, and gold is therefore going to be under pressure, or people are just not going to want to have it simply because you have real yields in bonds, and there's really not that much point in owning gold at the moment. I don't think inflation is going to reaccelerate. Growth might, let's say, not pick up, but stay at the levels that we have at the moment, and therefore no recession, and therefore no quick easing by the Fed or any other central bank. But that doesn't mean recession. That just means prices more or less in line with what they are at the moment. And if that is the case, people are just going to keep on abandoning gold at every opportunity they get. Let's start equities with the Blue Angels. To me, this is dangerous. I'm not saying it's going to be the end of the world. I'm saying this is dangerous, and we'll have a look in more detail at SPX and all the others. A downward sloping multiple, i.e., when we're not expecting bonds to do better, indicates that this is likely to come back at least to the times 18, if not lower. We had all those big tech earnings, and we've got very little in terms of earning next week that's going to move the needle from those huge capitalization companies. And whatever the market might want, whichever spin the market might want to give it, they weren't brilliant. And therefore these Blue Angels are going to keep on trending down rather than up or stabilizing. So to me, coming back to this times 18 is almost a given at some stage. And now let's have a look at the precise levels in SPX that are going to give us a hint. Let's start with a monthly chart of SPX, and let's try to enlarge this area. To me, 41.81 is a very, very important level. I know this is a monthly chart and we are at the beginning of the month, but my system was ringing every 2 minutes on Friday. Every time it got up to 41.81 on the SPX, which is in the 90s in ES, and every time it got there, I just sold a couple of lots and went away and covered at the close. I'm just buggering about. But to me, this is very, very significant. And if we go away from the monthly chart and we go to the 195-minute chart, we have almost an exactly the same level, 41.80. So, and we've never closed above it. Okay, we've tried, we've come back, and then at the close we spiked the 41.29. Where is real support? I reckon real support is not before 40.68. That's the kind of real support we have here. I've been saying all along, I mean, from way back here, don't be short of equities. I think the risk reward now is not to be long of equities in any way, shape or form. Unless we start closing above 41.81 in SPX, I think that the path of least resistance is going to be towards backing and filling, and probably all the way down to the 39.74 at some stage. It's just a feeling that I have. I don't think the relationship between bonds and equities is going to go very far out of line. You saw where we were in the Blue Angels. You know, this is what the market does. What happened here? Basically, what happened here is NASDAQ and nothing else. I think NASDAQ can easily come back towards 11,800, where I think it's a good risk reward long, for going back up and filling these gaps around 13,200, 300, something like that. Do I think we're starting a new bull market trend? I don't. I really can't, because I don't think the fundamentals are there for that to happen. I think the fundamentals are there for squeezes, and that's what we had. But if we have a look at something normal like YM, okay, and this is YM, let's have a look at the daily. What happened in YM last week? Nothing. It closed a little bit lower than it opened. The only reason why SPX went up is because you had a squeeze, a gamma squeeze on the high beta stocks. And nothing happened here in YM. I think the Dow, as you can see, is much more likely to trade in a tight range with a bottom around this 33,200. And I think we've probably already seen the top. All we did is we came and filled that gap. So I think it's going to be a tight trading in YM. You can see how important this 32,578 level is. We can't go below there. And if we can't go below there, the likelihood of XPX trading to new lows in the year is very, very low. So it's a period of relative stability where people who are selling gold and selling commodities are buying a little bit of real yield in bonds and probably buying some growth by buying equities on top. So it's a shift in the butterfly relationship between gold in the center and bonds and equities on the sides. I don't think bonds and equities go anywhere or even much better. But what that tells me is that if if bonds and equities do worse, gold is going to do much worse. And you need an improvement in bonds and equities for gold to even be stable. That's what the butterfly would imply to me. And I think all the other charts imply to me that we're going to have a bit of a correction stroke stability in equities. And I think in equities and in bonds, in both of them, you sell volatility, because I think the downside and upside are very capped. The one market actually that might suffer as a result of what I told you more than SPX is EEM. you can see how basically when I got out at 42.25 was wise. So EM was the worst performer last week, and that tells you that the idea that the dollar is going to be slightly stronger is probably sensible, and the idea that bond yields might back up a little bit is probably sensible. And I would love to see this 37.64 level again, because I think it's going to be a big buy if you see it. But probably you don't get much better than 39.93, simply because I don't see US equities falling out of bed, but certainly buying something between 39.93 and 37.64 is going to be a good idea. I don't think that this is enough of a retracement, and I don't see EM falling out of bed. I think at some stage this year we see these levels around 45. So to me, buying it down here makes a lot of sense. A little bit at 39.93, and then basically scale all the way down to 37.64. I don't think that we are done with this one. I won't bore you with all the risk spreads, but they're overextended, but they are not a single one is bearish, which basically to me means that any dip that I showed you as a possibility and levels in SPX are going to hold. This is not a market where you sell equities and go away. This is a market where you trade them against important levels. And I think that that is the same and what the Nikkei is implying. I think every time it comes down to 26,940 or 26,910, it's going to be a decent risk reward buy. So that to me is going to be one of the priorities, to put in bids at 26,940. If it's a period of consolidation and the dollar doing better, the Nikkei should like it and should be the least volatile. And even if you look at something like the VIX, I think the odds that we go a lot lower are very low at the moment, but also that we go above 20 to 22 area are not very good, which tells me it's going to be a period of stability in equities as well. Can they back up 2-3% like I showed you? Of course. But that is it. We are not going to get a disaster in equities. We are not going to get a disaster in bonds. The two are still tied together. Equities are probably much more overbought than bonds, and that's why they could retrace a little bit more in the short term. But that is neither here nor there. I think everything is telling you that we are going to have some nervous stability, and the relationship between asset prices is only potentially going to change in the gold and commodities area rather than in the equities and bonds, which to me says that no one really is that afraid of inflation, and that inflation is going to be a permanent feature, but only that it's going to be a temporary feature which the Fed is going to win against, whether that takes another couple of hikes or whatever, or higher for longer. The market is not afraid of that. And that is very, very good news for returns over the course of this year, I think. I hope what I've told you makes sense in the relationship between asset prices and how they're likely to move. The levels haven't really changed very much. The only one thing that I would say now is avoid DBC and gold and be careful with DXY. I think that's turned. And I think that has certain implications for the relationship between the US and Germany. So really, I wouldn't be shorting Germany at the moment. I would much rather short the short end of the shorter end of bonds. That might lead to a little bit of a backup in SPX, but I would be really, really surprised if A, we got to 39.74 next week, and B, if we didn't bounce like crazy off it, if we do get there. To me, equities are going to be in a 2-3% range for the rest of this month. And it's going to be very interesting to see if they can break above 41.81 and close above 41.81, in which case I would have to start getting really bullish. I doubt that's going to happen because I can't see the justification currently, not fundamentally and not technically. But, you know, the month is young, we shall see. That's about it. I would certainly not want to be long here. I'd much rather be long with volatility here, i.e. some sort of a straddle at 41.82, if it's cheap enough, because A, the upside, if it starts breaking up over the course of a month, could be quite significant, but also the downside could be at least 200 points from here, at least. So if a straddle is, you know, less than 200 points, I think is going to be cheap, but we shall have a look at that next week. Thank you very much indeed, and tweet you on Monday.